Hi, everybody. This is Dio, our community's attorney, and I wanted to come to you again. I know that I've missed being with you. Last week I was only up one day, and there's so much happening. I've got to get this message out to you guys. So I wanted to make sure to be on this week to continue the conversation that we were having last week. Last time we were together, I explained a little bit about servicer and lender, what the differences were, and I asked you to do one thing if you hadn't paid your mortgage. I asked you to call your servicer and request a figure, and whatever the amount was going to be, in order to get reinstated on your loan, to get a reinstatement. And I got some phone calls for folks that wanted my help to call the bank. Thank you very much for counting with me. Today, we're going to discuss calling the servicer again to request a modification this time. If the loan has lapsed for too long a time, a reinstatement might not be feasible, okay? But a modification may be feasible. And this is way better than losing your home to a foreclosure. So we want to try and save our home, okay? And this is what we're doing. Now, I want to talk to you again today about servicers and the lender. Remember, the lender is someone you don't really see, typically not until you get to the foreclosure part of the loan, that big scary F word. But the servicer is someone that you deal with all the time. So the servicer is the one that I want you to think about in these first chats that we're having. Now, one little secret that I'm going to let you in on. Servicers are required, typically, to pay at least the interest on your loan to the lender. They're in the middle, and even if the loan has gone unpaid, they are typically required to pay at least the interest on your loan. Once a loan payment is missed, a single loan payment, servicers have historically shifted focus, okay, from accepting the loan and everything being nice and hunky-dory between the borrower, you, and them, right? They've shifted focus and moved straight into foreclosure mode. Mostly because servicers have to pay the investor, the lender, that interest. And sometimes they also have to pay the principal amount. Now, when the foreclosure is concluded, the servicer then is reimbursed for all of their advancements, okay? So the entire time that the loan is not being paid, the only person losing money is the servicer. So that's why I keep telling you, let's contact the servicer. Let's call the servicer, okay? Even though they get paid back whatever they've advanced for the interest, whatever they've sent over to the lender for the interest, the cost to them of funding those advancements are never returned to them, okay? So it is in their best interest, it's my opinion, and many other attorneys that deal with this all the time, it's our opinion that it is in the servicer's best interest to help you get that modification if you're eligible for it. Enter the current crisis, right? Even before this crisis hit, many banks, many servicers were already readily offering modifications. Today, servicers are even more enthused to have that conversation with their borrowers and allow their customers to apply for the modification, ultimately granting the modifications where the borrower is eligible for them. Because a modification is going to allow the servicer to recover not just the advances of your interest that they've already sent to the lender, but the modification is going to allow the servicer to recover the cost of making those advances. So for me, I'm all excited, giving you good news, and I know that some of it just maybe went past your head, but what I want to tell you is there is clear incentive for your servicer to be able to work with you and help you get through a modification. Now, what in the world is a loan modification, right? Reinstatement was easy enough to explain. You get a figure from the bank. This is how much you got to repay to get your loan back started. And then we're all hunky-dory. Everything is the same. Loan modification, the explanation is not a one sentence, wham, bam, thank you, ma'am. This is what it is, right? So we're going to spend the next maybe 8 or 9 minutes reviewing a loan modification. It'll go quick. The loan modification is different from a reinstatement because it's not just a one lump sum that'll get you going again and all the terms are the same. A loan modification is also different from refinancing, okay? A lot of folks think it's nearly the same. Refinancing entails replacing your loan with a different loan, okay, with a new mortgage, which you may or may not be eligible to do if you've stopped paying your mortgage. It depends on your lender, whoever is going to lend you. A loan modification in and of itself changes the terms of your current mortgage loan without replacing it, okay? So it's the same mortgage, but the terms are now different. What does that mean? It can extend the term of your loan. So if you initially borrowed on a 30-year loan, once you modify it, if you've got a few years that you've paid off, if you've paid off, let's say 5 years, that means you have 25 more years left to your mortgage. Modifying the loan is going to extend it, re-extend it to maybe that 5 years or maybe even longer. By issuing you a modification, the bank, the servicer, and the lender, so the bank, they are allowing you more time to pay your mortgage loan, okay? A modification can also lower your interest rate for the life of the rest of the loan or just for some time. A loan modification can also change your loan from an adjustable rate to a fixed rate. I encourage all of my clients to get fixed rate mortgages. That way there's no surprises. Every month, you know what it is. If it's a 3.5% interest rate, it's not going to change. Somewhere down the line, it's not going to balloon up. It's not going to, there's no modification, there's no change in the interest rate. You know that you bought it and it was a 3.5% interest rate when you purchased it, and it'll be a 3.5% interest rate until the day you stop purchasing, okay? Now, some modification, not everybody gets a fixed rate mortgage loan, okay? Some get an adjustable rate mortgage loan where it's 3.5% now when you bought it, but 5 years down the line or 2.5 years down the line, it'll go up to 4%. And a few years longer, it'll go up to 5%. And this might cause a little bit of distress when your mortgage payment all of a sudden goes up and you forget that your interest rate is actually fluctuating. It's an adjustable interest rate, and that's the reason why your rate went up. A modification can modify these terms. Remember, three things it could do. It can extend the time that it's going to take you to pay your mortgage loan by extending the length of the term. It can lower your interest rate. It can either lower your interest rate for some time or lower your interest rate for the life of the loan. And it can change your interest rate altogether. It can change it from an adjustable rate to a fixed rate loan. The terms that are chosen are really not up to you and me. okay? The terms are up to the lender, but the most important thing is that the outcome of what happens to that modification is lower, more affordable monthly mortgage payments. Now, once you've stopped making your mortgage loan payments, and I want to go back to our very first Facebook Live chat that we ever had, okay? Where I encouraged you to make your mortgage payment. If you hadn't, make the payment. If you haven't, make the payment. Let's not plan to default on purpose, okay? If we have it, let's make the payment. But if you don't, once you can't make that payment and you've stopped making it, then you can request that the servicer send you a modification application. Some servicers even have them readily available on their website for a download. But don't just download the application, okay, if that's the case with your bank. Don't just download it, fill it out, and send it in. Remember, I am a fan. Always call the bank. Always. As I've told you before, not speaking to the bank will actually make things worse. So we're going to build a rapport with our servicer. We're going to call them, okay? So don't put that off. In order to get a loan modification, you are going to have to get so much paperwork together and in order. And I'm not saying this to scare you. I'm saying it because it's true. I want you to know that this is what you're going to need. So start from now. Gather your bank statements. If you're still working and if you're still getting paid, gather your most recent pay stubs. If you stopped working, gather whatever you got before you stopped working. If you're collecting unemployment, keep those stubs when they come in. Most importantly, above all, know what's on your credit report. Now, I haven't said the words credit report the entire time that I've been talking to you, but it's extremely important for you to know what's on your credit report. The key to getting a loan modification is being able to actually sustain the debt. A mortgage loan is a debt. So it's important to know how much overall debt you already have. And we can help you complete that analysis. It's not a quick application. It takes time and it takes lots of energy and plenty of communication. But if you have not been able to pay your mortgage and you're afraid of losing your home, the benefits of taking the time to complete the application and to do it right, to get a loan modification, far outweigh the headaches of the process of getting there. I have an entire team with me to help you make that process easier. Just give me a ring. My number, 631-538-0008. You can also send me a direct message on Facebook. I answer all of them, and I try to do it as quickly as possible. You can also join our private Facebook group, Home Help NY. Whichever way you do, reach out to me. I want you to realize that I'm here to help you in any way that I can. I hope you have a great night. May the Lord bless you.